Thank you so much. For more on reaction to the Fed's decision on inaction, joining me now is First Trust Chief Economist Brian Wesbury, and on the phone is Hedgeye's Keith McCullough. Brian, good to see you. Keith, thank you so much for calling in. We know that you watched the Fed decision from your wife's hospital room. Congratulations on the new baby.
Thank you, Maria. Thank you. It's an incredible blessing, and we have a lot to be grateful for.
And I want to talk to you about this unbelievable call that you've had for the last year and a half, Keith. You have been saying that the Fed will not be able to raise interest rates because of the global growth story slowing, the global slowdown. What's your take on what we saw yesterday?
Well, I think you have the combination of both happening right now. You have, obviously global growth is slowing. That is a factor, but the bigger factor above and beyond that is, of course, that the Federal Reserve is playing catch-up on a lag to a U.S. slowdown. A lot of people who will be talking today or talking yesterday, they will quickly say, well, the U.S. is fine. Well, in rate of change terms, the U.S. is clearly slowing. Whether you look at employment growth, wage growth, or consumer confidence for that matter, they're all really late cycle at this point. And our forecast is that GDP in the third quarter is going to have, at best, a 1 in front of it. And again, you're going to fast forward to a December meeting, and the Fed's going to have to talk a lot more about the U.S. slowdown than anything else. So, again, I think it's just what the market's been baking in for a long time now. Anybody who's been long growth stocks for the last 3 months has been paying the price for buying the dips, and we've been saying sell the rips.
Yeah, but Brian, you're on the other side of that because you basically say, look, a quarter point wasn't going to do squat anyway, so why aren't we just getting off of zero? Is that your take?
Yeah, that's exactly right. Well, first of all, congratulations, Keith. That's awesome. Having children is having kids is one of the best things of life. It's awesome.
Thanks. I've done it 4 times now. It's just fantastic.
This is his fourth.
Well, then you know.
3 girls.
Then you know.
You're in big trouble. 3 girls. Go ahead,
that's the part of life, Brian, that I'm really bullish on growth on.
Yeah, well, you know what? How much credit do you give Janet Yellen for having kids? It's like,
come on, Brian.
Oh, I'm not kidding you, because everybody acts like Janet Yellen creates the world. Like if we didn't have the Fed and Draghi and Abe, that the world wouldn't grow. And in reality, it's individuals, it's families, it's businesses that create wealth, that create our higher standard of living. The Federal Reserve doesn't do it. In fact, here they didn't raise interest rates yesterday, and the stock market's down 1%. That's right. Japan is down. They've been doing QE for 30 years, and they're still in deep due. Draghi has done QE, and the stock market is down since they did QE. So this concept that the Federal Reserve drives growth, there's no proof that it's true.
Okay, I understand that, but I got to tell you, this is exactly the reaction that I expected, that the markets would be down if the Federal Reserve did not raise interest rates, because the Federal Reserve just told us what they think about the economy, that we are seeing the U.S. slow down and that we are not going to be able to see sustained growth when all of our trading partners are being challenged. So the question now is, what does this mean for Americans at home?
Yeah, well, here's the deal. The Federal Reserve didn't see the crisis coming in 2008. The last time unemployment was at 5.1%, the federal funds rate was 4%. Today it's 0.13. We have on a 4-week moving average basis, there's only 275,000 initial claims right now. That's the lowest that we've seen since 1973. You know what the federal funds rate was in 1973? 8.7%. So this idea that somehow having these 0% interest rates is driving all of this, it's not true. I don't agree with Keith that the economy is slowing down significantly.
Oh, Brian, we had 9 straight months of factory orders declining. We've got the industrial side of the economy collapsing, as seen through the commodities complex. We've got a participation rate that shows 38% of working age Americans don't have a job and don't intend to look for a job.
And I'm not arguing that we don't have some issues with our economy, but I believe they come from other government policies. When we overregulate, when we overspend, when we redistribute income, when we pay people not to work, that's what creates all these structural problems. Right. It's not the Fed's job to fix that.
Hey, Keith, it's Mike Murphy. Congratulations.
Hey, thanks, Mike.
One more to catch up to me. So, Keith, I know your call that you've made, and I know your stance on this, but I'm just wondering, what do you suppose, what would be your suggestion for Yellen and the Fed now? Because for me, I think they should have raised. But I get your point. They couldn't. But what is their next step then, in your opinion?
Well, to be clear, and thanks again for the congratulations. Having 5 kids, that's big time, Mike. That's awesome.
Well, do it again, because you got to catch up to Mike.
Like, to be clear, and this is where I completely agree with, I think both of you. I agree with Brian as well. The Federal Reserve cannot print growth. I think everybody knows that, who's analyzed not only U.S. monetary policy history, but the monetary policy experiments of everyone far and wide. So I would have said that, the Federal Reserve, if they raised rates or if they didn't do anything, the stock market was still going to go down because growth is slowing. That's the point. The Federal Reserve cannot smooth gravity. They cannot bend gravity. If growth is going from 3 to 2 to 1, which has been our call, that's all it is. Like, I don't think it's any more complicated than that. And the reality is that Maria's right. I mean, whether you look at any cyclical indicator, which would include the stock market, I might add, or cyclical factors within the stock market, the industrials and the transports have been signaling this for a long time. Again, the stock market says that we're right on this. And I think that it's going to take up until probably the end of November when you're going to get the Q3 GDP report. And again, I have 2 scenarios, 0 or 1.5. And again, it's not 2, it's not 3. And I think the Federal Reserve in that scenario, God forbid that there's another bad jobs report pending in between now and then, I do think that the Federal Reserve is going to be operating on a lag to slowing economic data.
Keith, I know you've had your clients in cash. Are you telling your clients after this decision to put some more of that money into stocks, or are you sitting still?
Or are you buying gold?
Yeah. Well, gold and bonds. I mean, we have 3 positions, cash, gold, and bonds. And we haven't liked gold, by the way, up until really for the last 3 years. And the main reason why gold's going the main reason why gold's going up has 2 very obvious reasons. Interest rates are down and the dollar's down. That's what gold loved in 2011. That's what it loves now. So if the Federal Reserve has to attempt to devalue the dollar that's why these things are up. Because to Brian's point, the true growth is the 5 children that Mike Murphy has, the 4 that I have. That's organic growth. That's hardcore growth. Growth is not inflation. The illusion of growth through stock market, or really through Fed manipulation of the currency, that is a joke. That's an illusion of growth.
By the way, the German DAX index is down 3% right now, Keith. I mean, right. Brian, that's also an indication that we're not seeing such a rosy picture in Europe either.
No, and people are saying, should we buy Europe because Draghi did QE? I said no. Don't buy Europe because of QE, because QE doesn't create growth. It didn't create growth here. And look, we have had some weaker economic data. I can't call 173,000 jobs a horrible jobs number.
No,
but
it's not horrible. It's just weaker than expected.
Everybody keeps calling it that, and it'll be revised up, and but I can't argue with that. However, I have heard this for 6.5 years. Every time GDP went from 3.2 down to 2.1, then it was going to go to 1 and 0, and then instead it went back up. Every time retail sales fell for a couple months, they were going to go back up. In the third quarter, consumer spending will be up over 3% at a real rate after inflation. That's even with huge declines in gasoline prices. So
we'll see about that because we've been waiting for the consumer.
But these are, and Brian, you know this. I mean, and I was bullish on growth and bearish on bonds and bearish on gold throughout the end of 2012 through 2013 when growth's accelerating. All we care about is the rate of change in the economy. This is called a cycle, and again, the cycle slows. We're 76 months in to U.S. economic cycle. What happens at the end of the cycle, Maria? Employment and consumption peaks, and that's the point. They've peaked in rate of change terms.
Cycles end when the Federal Reserve withdraws the excess liquidity. And that's one final point, at least I hope I get a chance to make here.
Go ahead, real quick.
And that is that the Federal Reserve has added $2.5 trillion worth of excess reserves. This is money that the banks could lend out that they haven't. Raising interest rates today, they typically in the past, when they would raise rates, they would actually withdraw liquidity. All they're doing now is saying we want rates higher. All this extra liquidity will still be in the system.
Yeah.
So even going to quarter is not tightening. It's not even remotely close to tightening. It's not like it was in history.
It's a scary sight that they're, even with everything you just said, they're still afraid to do it for a quarter point.
Yeah,
Brian Wesbury, Keith McCullough, great conversation. We appreciate your insights,
Thanks,
gentlemen.
guys.